Hello everyone again. This is the third video of the series I have prepared for you. If you haven't watched the previous videos, I recommend that you do. You might say that we are quite good at investing, but the questions in my mind never end. Because those charts go down, or I read a piece of news, then I start to panic. Should I exit this investment, or should I wait? Everyone bought it. Am I the only one who missed out? These are exactly the issues we'll talk about today. In the previous episodes, we learned what investment is and also discovered what kind of investor profile we have. But now you might be thinking, if my investment is going down, should I exit immediately or stay? Or other investments are rising, should I join them or not? You might feel confused at this point. So what are we going to do in such a situation? I think this is where everyone truly gets confused, because you can encounter this problem even among professionals. Since this is an emotional matter, it means the issue starts here. First of all, investing is not just about choosing the right instrument. We also need to prepare our minds. After all, markets are not calm every day. There are areas with very high volatility, that is, where fluctuations are very intense. Sometimes it goes down and you think, will I lose? And sometimes it goes up and you think, am I missing an opportunity? So as the market changes every day, your emotions naturally change as well. So how should we manage these changing emotions? You should always ask yourself this question. Is the first decision that comes to my mind rational? Is it based on data? We prepare our minds, we take a deep breath, and invest with a rational action plan. Ultimately, you're the one who will make the final decision. Determining the investment horizon is very important. Do you want to achieve a result in the short term, or do you want to make a long-term investment and get a result by setting it aside and forgetting it? Deciding this horizon from the beginning and being consistent about it will help you a lot. In other words, make a plan and stick to it. Investment is also like an agreement you make with yourself. From the very beginning, you must agree with yourself on the terms of this agreement. Another clause of this agreement should be the return amount. You should determine in advance the level of return that will satisfy you or how much loss you are willing to tolerate when losses begin. Having these clearly defined will make you more resilient against unexpected fluctuations. So does this agreement never change? After all, market conditions change. You might say that your own conditions can also change. For example, you may have an action plan that you want to stay loyal to, but if conditions change, shouldn't your plan also change? This means we are gradually moving toward becoming a serious investor. Of course, there are two main situations in which you need to review your investment plan. This is very important. First, when there is a risk arising from general factors that affect all financial instruments. You can also include geopolitical risks here. In other words, an external risk may emerge. Second, there may be changes in risks stemming from the specific characteristics of the financial instrument you have invested in. So what should you do in this case? You need to review your plan again. In these two situations, alarms will go off. To better understand these conceptual definitions, it helps to give examples so that these signals can be more easily recognized. If there is a recession in the overall economy, it will affect all financial instruments. It is not possible to escape this effect, and you may need to review your plans. As another example, a change in climate conditions may affect several sectors. In that case, we can make more specific evaluations and decisions. So how will we make healthy decisions while those charts are rising or falling? This is one of the most frequently asked questions. Believe me, this is the most important issue on everyone's desk in the investment world. After all, we are all human. There are many alerts related to the investment market, instant and daily developments, declines, rises, news, and so on. These can cause changes in everyone's investment expectations. Before making a sale or purchase, you need to stop and ask yourself this question. Why am I making this decision right now? Is it because my analysis tells me so? You need to pause and think. Preventing that automatic reflex is very important here. In moments when we cannot find a solution, we need guidance. Having an investment plan will provide you with that guidance. For example, if you are investing for the long term, you might say, I will not panic if it drops by this much. I will invest this amount monthly. Or you may set rules such as what percentage of your portfolio you will keep in risky assets. You need rules that protect you from yourself. This is actually one of my favorite things. We live in a world where things rise and fall within seconds. It is completely normal for markets to fluctuate daily. There are also automated systems that act on your behalf without requiring human intervention. You can include these in your plan as well. For example, it can automatically sell when a certain loss level is reached. Similarly, it can automatically buy when an investment falls to a level you have determined. As for regular investing, you invest continuously every month with a certain budget. To sum up, today we have ensured that you learned this. You have a plan and a strategy, and along this path, you should try to manage your investments according to that plan. No one has to be perfect, but being aware is good. And with that, I am ending this episode. In the next episode, we will talk about interest rates, inflation, and risk. See you in the next episode. Thank you for listening. Don't forget to subscribe.